Are you nervous about being laid off? Well, according to the news, you should be. Unless you're a tradesperson or a healthcare worker, AI is coming for your job.
At least that's what a lot of CEOs have been telling us. In the last several months, companies have been shedding white-collar jobs like crazy and attributing it to artificial intelligence.
Right now, it seems concentrated in the tech sector. But if this trend continues, it's only a matter of time until this show is written, hosted, and edited by algorithms.
Unless it already is. Are we real? Or the hallucination of an LLM trained on hundreds of 2-cent episodes?
Don't be silly. If that were the case, it probably would have given me my old mustache.
Yeah, I guess you're right.
Before we go full Black Mirror, it's important to take these CEOs' assertions with a big grain of salt. The actual evidence points to a future that is neither as profitable for companies or as frightening for workers as the hype suggests.
In fact, what worries me most is why these companies would want to blame AI.
2025 turned out to be a pretty lousy year for the job market. Every month of job growth came in below the average for the previous year, amounting to a yearly total that was the worst since 2009, not including COVID. And 2026 doesn't look much better, with a lot of high-profile layoffs at big tech companies like Amazon, Salesforce, Pinterest, and Klarna. In February of 2026, the finance tech firm Block announced it would cut half its workforce, and Mark Zuckerberg is reportedly planning to lay off 20% of Meta's staff.
Most of these CEOs are telling their shareholders and the public that these workers are no longer needed because of the huge increase in productivity powered by AI. Thanks to ChatGPT and Claude Code, tasks that used to take all day are now finished in a matter of minutes. One employee can do the work of 10. That's a bit of an exaggeration, but the basic story we're hearing again and again is that across industries, AI is making human workers obsolete.
Except that it's not, really. While there are some isolated examples of certain tasks being streamlined by AI, like customer service and legal research, on the macro level, economists have yet to see a significant impact. The Penn-Wharton budget model estimated a 0.01% boost to productivity in 2025 due to AI, and in a survey of over 6,000 senior business executives, 90% reported no impact to productivity or employment. A lot of companies are investing in AI, and investing heavily, but very few have implemented it in a way that saves substantial time or money.
One reason for this discrepancy might be an economic theory known as the productivity paradox. In the 1970s and 80s, US companies poured tons of money into information technology. In a very short span of time, computers went from a specialized rarity to a commonplace object in stores, homes, and offices. Typewriters and credit card imprinters were quickly replaced by word processors and point-of-sale terminals. Think of the time saved! And yet, for 25 years, productivity growth actually slowed. How could that be?
Well, according to some economists, just because a new technology is powerful doesn't mean we know how to use it yet. It can take a long time for existing systems to adapt. There's a lot of trial and error and wasted time and money. That may be what's happening with AI today. Think of fast food restaurants that scrapped their AI-based ordering systems, or help centers that had to rehire human operators after customer complaints. According to MIT, 95% of AI pilot programs in the workplace have failed.
This experimental stage may actually be having a negative impact on productivity. Workers report being forced to use AI even when they don't want to. Some studies show that teams using AI take longer to finish tasks, and the quality of the work can suffer, known as work slop, which requires more quality control on the back end.
Take Block, for instance. Although the company heads bragged about a 40% increase in code production, 95% of their AI-produced code had to be altered by human coders because it wasn't up to company standards, increasing the time spent on human reviews by 91%. Essentially, engineers across the tech industry are spending less time writing code, but more time fixing sloppy AI code. It's fueling feelings of burnout, resentment, and job dissatisfaction.
How does all of this square with what CEOs are saying? To be fair, not all these companies are claiming that AI has already replaced workers. Meta and Pinterest both justified their staff cuts as a way to free up money to invest more heavily in AI. CEO Andy Jassy initially blamed AI for the loss of over 30,000 jobs at Amazon before backpedaling that the layoffs were not really AI-driven, not right now at least. One survey found that the majority of organizations who cited AI as a reason for cutting staff had done so in anticipation of productivity gains.
The discrepancy between what they're saying and what's really happening could be as simple as that. All these CEOs are so convinced that AI will make human workers obsolete someday that they're just going to go ahead and lay everyone off now.
But skeptics argue that there might be another, more urgent incentive for this narrative.
Our economy is in a bit of a bubble, if you haven't noticed. OpenAI's market valuation is greater than Netflix, Chevron, or McDonald's, even though they have yet to figure out how to make a profit. Investors seem to be much less interested in how a company is doing than how they are positioned to do in the future. And no buzzword communicates future potential quite like AI.
So, if you're a CEO who just had to lay off a bunch of employees, would you rather tell your shareholders that it's because sales are down or because you're embracing an exciting new technology? The former might lower your stock value, while the latter might give it a boost. That's what happened to Block. The company had been suffering from a declining valuation for several months. But after CEO Jack Dorsey announced the supposedly AI-driven layoffs, the stock price jumped 20%.
As if the pressure from the stock market wasn't enough, there's another wild card at play: Donald Trump. This president has shown a willingness to use his office to punish companies and CEOs who displease him. Blaming layoffs on tariffs or a sluggish economy could attract unwanted attention from the White House. It's much safer to paint a rosy picture of technological efficiency.
So, if AI isn't behind the layoffs, what's going on? Many analysts think that this is a normal market correction. The pandemic was a great time for tech companies, with all of us stuck indoors on our screens, and they went on a hiring spree. Today, they simply don't need as much staff, and AI makes a great excuse to let them go, a tactic some call AI washing.
That isn't to say AI isn't coming for your job someday, but as of now, the productivity gains are not enough to justify the staggering amount of money being poured into it. And that is perhaps the final, most important incentive of all. These tech CEOs have raised hundreds of billions of dollars on the promise that AI will be the most revolutionary technology since the combustion engine. According to some estimates, the entire American economy is being propped up by AI-related spending, and the only way to make a return on an investment that huge is if it actually does eliminate millions of jobs.
But about 3 years after the launch of ChatGPT, we're still not seeing it in the numbers, and investors are starting to get a little antsy.
Maybe these CEOs really do think that massive productivity gains are just around the corner.
Or maybe they're just trying to keep the party going a little while longer.
And that's our 2 cents.